Well, welcome back. Netflix shares on the move this morning. Take a look, up almost 11% after the company's latest earnings report streamed past Wall Street's expectations. The key number was subscriber growth, which came in at 5.2 million, nearly 2 million more than was actually expected. Joining us right now to talk more about that and other tech names, Morgan Creek Capital Management CEO and CIO, Mark Yusko. Mark, good to see you. Thanks so much for joining us.
Thanks for having me on.
Surprised by Netflix?
You know, not really surprised. We were talking yesterday at our internal meeting about expectations and that they really needed to hit subscriber growth, and they really hit it out of the park. So, good.
The stock, though, I mean, in terms of valuations, when you look at a Netflix, when you look at some of the other names out there, even though, you know, tech has come off of the highs, would you still commit new money to this area?
It's tough. The valuation of Netflix in particular is extremely high. I mean, you're talking at 50 times enterprise value, so really, really high. But as long as they keep executing, as long as they keep, as we were talking in the break, disrupting their competition, we think it's very attractive.
Yeah, remember, I mean, Netflix was almost on death's door for a while, right? And they've had this resurgence. They just outgrew their facilities in Beverly Hills, moved to a bigger, a bigger enterprise. My experience with this is whether it's Netflix, HBO, others, they are disintermediating the traditional distributors.
Right.
Now, that's not the big movies, the big films. They're still going that way. But a lot of films now are being produced, indies, and going directly and disintermediating, bypassing distributors, and therefore getting more financials back into the projects, I think. Don't you see? It's a little bit like Amazon.
It's about time management. Time management. You know, when I grew up, you had to be in your chair 8 o'clock Tuesday night to watch Happy Days. You don't do that anymore. You watch TV when you want. You stream when you want. And I think the flexibility and the freedom, plus the content quality is so high on some of these shows. You take Billions on Showtime, really great content.
And a lot of them are co-producing now to make sure they get the content.
I would argue with that Billions is not that good of a program. But that actually does raise a central issue for Netflix and all of these content providers is, does the quality go down as there are more players competing for that content, where you're going to end up having to overpay for mediocre content? I've been wrong about Netflix for the last couple years. They've canceled some shows, but they've still had incredible successes. But they're going to spend $6 billion on original content this year. So far in these subscriber numbers, 4 million overseas, 1 million in North America for the quarter. They have been able to deliver content that is attracting new subscribers. But at what point could that change? I think that's a central question.
Look, they're writing big checks for content, for producers, for talent, and the traditional guys are worried because they're spending.
And you have a Facebook that's getting into original content. You will, I anticipate either Apple buys something or Apple starts throwing billions upon billions at content.
Rumor is one of them are going to buy Disney. Mark, what do you think?
Look, I think it is that's a great anchor tenant if you were going to build a media empire. And there are a lot of companies with a lot of cash. And part of that cash is going to eventually find its way into the market, and that's probably a good place to start. I just took my 6-year-old to Disney, and I could not believe how crowded it was. And
they're executing. They've been executing well for a lot of years, actually. Let me talk to you about other earnings, because we've got a lot coming out this morning. We've got Bank of America, Goldman Sachs. Second quarter earnings period. What are you expecting?
We think it's going to be slightly disappointing. I think a lot of people got really excited. We have double-digit growth. I think that's probably not going to happen, particularly on the energy side, where spectacular fourth quarter numbers, probably less spectacular than the first quarter. But we think it'll be good.
Well, first quarter was up 15% on profits. And so far, we're tracking up 6% on profits this quarter.
Mid-single digits, maybe even 5-4% probably.
Favorite technology name? I mean, when you look at a Facebook, which you've been a fan of for a long time, and Amazon.
Look, the FANG stocks, everybody loves them. I like the second A, if you added an A to FANG, and I like Apple. I think, my thing is ultimately profits matter. And, Apple, for example, I say swap the A. Apple made more in the fourth quarter last year than Amazon's ever made in their history. So I look at relative valuation, and I like those.
Mark, early reports is that the new phone coming out is going to be a disappointment from Apple.
I think that's certainly possible. They tend to be off again, on again. Like the odd number releases are really good. Even haven't been so good. Not sure why that is.
That's weird.
Yeah, it is strange.
But this is going to be a major redesign from the phone that we have now, according to reports.
Look, I think Apple historically, if you look at history, people poo-poo the announcement and the changes and the upgrades, and then somehow when they actually release, everybody says, oh, I've got to have it. I mean, I've got my big 7 Plus, and so I'm pretty excited. But I agree with you that these incremental changes, like when they add the S, or maybe it's the even numbers versus size, I don't know.
Yeah, but $1,000 copy is a big number.
It's a big number. Well, and it's a bigger number because it used to not hit your pocketbook because it was in your subsidized phone bill.
Yes.
Now suddenly you have to pay that.
Yep.
And there was an interesting hit. You had a one-time boost to earnings at Verizon and AT&T when they did away with the subsidies. Those stocks went way up high. Now they've been crashing because people are realizing, wait, that was just a one-time earnings boost.
Not sustainable.
Not sustainable.
Is there reason to say I'm going to sit on the sidelines for the summertime in technology? Not much more money to be made at this point over the near term.
Our view is that the summertime was going to be the last cathartic move up into the fall, and we actually get very nervous coming into the fall. You'll get historical patterns. You know, sell in May and go away, come back on St. Leger's Day. That usually plays out. We think this time it's going to play out a little different in that there's a low volume melt-up kind of happening with all the good news or perceived good news. And so we think it could rally through July and August. And then when people come back from vacation and look at valuations and say, yeah, I think I need to sell. So we're worried about downturn in the fall.
All right. We'll be watching that. Mark, great to see you. Thanks so much.
Mark.
Mark Yusko joining us there. Kevin